So, good day, everyone. My name is Adejuwan, and I'm one of your tutors for performance management. You had Mr. Ashwaju on Tuesday, and we are the two solid partners that will be doing justice to performance management during the course of this diet. And without wasting more time, I would like to show you my areas of scope on performance management for the diet. Okay. Yes. As far as my scope is concerned, I will be the one to take your operating statements. Then thereafter, once we are done with operating statement, then we'll talk about uh, we are going to do relevant cost for decision making, or you call it relevant costing. Then also we are going to treat short-term decisions. Okay. Then thereafter, we will do optimal product mix decisions. We are going to treat linear programming in the class as part of my scope. Thereafter, we will also discuss cost volume profit analysis, which you also known as a break-even analysis. It is also part of my scope to teach you risk and uncertainty. Then finally,
Hello.
we're also going to do learning curve and experience learning
What is
and
it?
experience theory.
Thank you.
Please, as a rule of engagement, you are not allowed to speak in my class. Once the class begins, you have to mute yourself. I don't like any background noise that will disrupt the activity or the flow of the class. So please, at all time, once you join the class, just mute yourself. If you have any question to ask me or you need any clarification, just raise your hand and I will allow you to talk. Please, it's very disruptive to be speaking at the background. All right. Thank you very much. Okay, then. So now that you know the scope that will be taking you for this diet, let the class begin almost immediately. Ordinarily, I'm supposed to run you through overview of what each of the topics entail, but we don't have that luxury of time. Let's dive in straight into the discussion or into the lecture of the day. Our first topic will be operating statements because there are some of these topics that I mentioned to you are closely related to marginal costing technique, and it is important and it is only reasonable for us to start with operating statements so that you have idea where we are going, particularly when we get to decision making. All right, so let's take it one after the other. So we are starting with operating statements. Okay, now what do you mean by operating statements? What is operating statements? Simply put, operating statements is a statement that shows the operating performance or results of an organization at a particular period, at a specified future date or period. All right. It is also known as income statements. Okay. And basically, there are two. You have the material at your hand. Please, you can open to it so that I can just um, talk through the concept. Okay. So basically, we have two methods of presenting income statements. One is marginal costing approach, and the second one is absorption costing approach. And one more thing I need to tell you, please, I wouldn't know if I'm too fast. You need to call my attention. Okay, tell me, let me know that I'm too fast so that I can make adjustments. All right, because I'm not seeing your face. I can't read your mood. So I wouldn't know if I'm fast or not. Please let me know at all time when you realize that this guy is going too fast and I'm not getting it, because your essence, the reason why you are in the class is because you don't know and you want to know. So it is my joy, it is my responsibility to be able to provide clarity to your learning. All right. So that is as per that. Now, like I said, there are two methods of presenting income statement, just like you have profit or loss accounts. Okay, you can call it statement of profit or loss account or income statement. So we are saying the same thing here. The profit or loss accounts is for public consumption. This operating statements or income statement, as we call it, is for management consumption. It's not for public. So that's some of the difference between the two. All right. However, I mentioned that there are two methods of presenting income statements. We have marginal costing approach, and then two, we have absorption costing approach. Let's talk about each of them. What do you mean by marginal costing approach? The marginal costing technique is a concept that charge the total variable cost of production to the unit cost of a product. I repeat, the marginal costing approach is a concept that charge the total variable cost of production, including direct material, direct labor, direct expenses, and variable overhead to the unit cost of a product. It is an accounting system whereby the fixed costs incurred during the period are written off fully from the aggregate contribution. So that is marginal costing approach. So all direct costs of production, all marginal cost of production, all variable cost of production, including variable production overhead, are charged to the unit cost of a product. Meaning that anytime you want to determine the cost unit or unit cost of a product, let's say, for example, you want to determine how much a marker will cost. Maybe you are a manufacturer of a marker and you want to determine how much will it cost you to produce a marker. Therefore, in doing that, using marginal costing approach, you are going to add up all the direct costs. For example, let me say total variable cost per unit. So you are going to add up direct material, direct labor costs, direct expenses, then variable overhead, variable production overhead. So you add all these four items together. That will give you the total variable cost per unit. Okay, so to now determine the unit cost of a product, you are supposed to add up all these costs. Okay, you add up all these costs. Of course, this is just the cost per unit. We are talking about total cost in this case. It will be direct material cost, direct labor cost, direct expenses, and variable production overhead. So you add all of them together to become production cost. So this is what you need to do as far as marginal costing approach is concerned. All right, so that is basically what marginal costing technique is all about. What are the key points? What are the features of marginal costing technique that you need to take into consideration? I can use the format of marginal costing technique to explain this, but first thing first, let me go up there and let me see if I have, okay, let me see if I have it here. It should be here. Yes, I have some of them here. So I'll just make the remaining, anyone who don't have it, I will add it to it. Now, what are the features or key points you need to take into consideration under marginal costing approach? One point that is very critical is that opening and closing stocks are valued at total variable cost per unit. I repeat, in determining production cost, for a product or service, or for a product, okay, in determining production cost for a product, right? Opening and closing stocks are valued at total variable cost per unit. See all the items that are listed here, okay? All these items that are listed per unit. So you go to the question as given to you. You go and pick the direct material cost per unit, direct labor cost per unit, direct expenses, and then variable production overhead per unit. You are going to add all of them together. That is your total variable cost per unit. Then you now go back to the question to go and identify if you are given any opening stocks in units. So if you are given opening stock in units, so you pick the amount given to you, then you now multiply with the total variable cost per unit that you have determined. So that will give you the value of the opening stock. Of course, closing stocks is determined. You are the one that will determine the closing stock, and I will demonstrate it for you how to do it later on as we proceed, as we progress. Okay, so that is basically one of the features of marginal costing technique. I said that opening and closing stocks are valued at total variable cost per unit. So that's number one. Then number two, under marginal costing approach, fixed production overhead is not part of production cost. I repeat, under marginal costing approach, fixed production overhead is not part of production cost. Rather, it is written off fully from the aggregate contribution. When you say written off, it means it's deducted. You are going to deduct fixed production overhead from your total contribution margin. You are going to deduct it from your contribution margin. That's what we mean by written off fully. Okay, that's number two. Then number three, the third one, quickly, let me just check. I think somebody sent a message. Let me see, so that please, you are too fast. Really, Mary? Okay, all right. I told you it's my nature. I, I will adjust. Okay, Mary, I've heard you. I will adjust. All right. So let me repeat the first one, the first and the second. I said the first step, the first point that you should know under marginal costing approach is that opening and closing stocks are valued at total variable cost per unit. In this case, you go to the question, you will identify the opening stock as given to you. You then go and calculate the direct cost per unit, that is the variable cost per unit. Add all of them together. It is not compulsory that you are going to have all the four components of variable cost per unit. It may well be that your examiner may give you just only two line items. You may be given three. All right. So it's not compulsory that you must have the entire four. All right. So once you add up the total variable cost per unit, then you multiply with the opening stocks. Okay. So that will give you the value of the opening stock. The second feature that I mentioned is that fixed production overhead is not part of production cost under marginal costing technique. You don't consider fixed production overhead under marginal costing approach. Rather, it is written off fully from the aggregate contribution. Okay, that's number two. Then number three, under marginal costing approach, fixed production overhead and other fixed costs are costs that have no sympathy for activity level. Okay? I repeat, under marginal costing approach, fixed production overhead and other fixed costs are costs that have no sympathy for activity level, meaning that irrespective of activity level, irrespective of actual unit produced, the fixed production overhead will not change. It will remain constant. It doesn't vary. It will remain constant because it is based on the budgeted output. I repeat, under marginal costing approach, fixed production overhead and other fixed costs are will remain constant because they are costs that have no sympathy for activity level. Irrespective of number of units produced, your fixed production overhead will remain constant. It will not change because it is based on the budgeted output. That is, just multiply to get your fixed production overhead under marginal costing approach. Just multiply the budgeted output, okay? The unit budgeted or budgeted output. You multiply with the fixed overhead absorption rate, okay? Fixed overhead absorption rate. So this will give you the fixed production overhead. All right, so that's what you need to do. It will remain constant. It is constant because it is based, you are multiplying the fixed overhead absorption rate with the budgeted output until your budgeted output changes. If your budgeted output does not change, then it means that your fixed production overhead will not change for the period under consideration. Now, number 4, future, you need to consider under marginal costing approach or key points is that marginal costing approach uses contribution margin, unlike absorption costing method that uses gross profit. Okay, that's point number 4. Under marginal costing approach or marginal costing approach is a concept that recognizes contribution, whereas the absorption costing method uses gross profits. That's number 4. Then number 5 point that you need to consider is that marginal costing approach does not recognize or does not consider overhead absorption costing. Okay? Marginal costing approach does not consider overhead absorption costing. Okay? Whether your overhead is under or over absorbed. So marginal costing approach is less concerned with that. Okay, so those are the 5 key points you need to take into consideration as far as marginal costing approach is concerned. However, marginal costing technique is a concept designed principally to aid managerial decision. I repeat, this point is very important. Marginal costing approach is a technique designed principally to aid managerial decision. The concept or the technique allow management to focus on the key critical success factor of the business or those areas, those activities of the business that are strategic to achieving the organization's objectives. All right. So marginal costing approach allow management to focus on those areas that are critical to achieving the company's aim and objective. All right. So anytime you are talking about decision making, you need the technique of marginal costing approach. I repeat, because this is very common in ICAN. All right. This is very common in ICAN. Marginal costing technique is a technique designed principally to aid managerial decision because it allows management to focus on those areas of the business that are critical to achieving to achieving the organization's objectives. All right. So that is as per marginal costing approach. Let me check. Somebody's chatting me. Children, I'm still fast. Okay. All right. I will still adjust. That's what I'm repeating it. If I'm fast, so I like to ask, I will then repeat it like 2, 3 times so that you can grab it. Okay. Sorry, it's my nature. I don't know how to talk slowly, but I will adjust. All right. So I missed 4 points. Point 4. The point 4, I said that I think point four was, okay, let me just recap all the futures or the points. The first point is that opening under marginal costing approach, opening and closing stocks are valued at total variable cost per unit. Okay, then point two, under marginal costing approach, fixed production overhead is not part of production cost. Rather, it is written off fully from the aggregate contribution. That's point number two. The third feature is that under marginal costing approach, fixed production overhead is a cost that has no sympathy for activity level. This means that irrespective of number of units produced, fixed costs will not change. It will remain constant. Why? Because it is based on the budgeted output. So for this purpose, when you now want to determine your fixed production overhead, we are supposed to multiply the budgeted output with the fixed overhead absorption rate. FOAR is the fixed overhead absorption rate. Then point number four, I said that under marginal costing approach uses contribution margin, unlike absorption costing that uses gross profits. Okay, then point number five, I said that marginal costing approach does not consider overhead absorption costing. Okay, those are the 5 points that are measured of futures that are mentioned in relation to marginal costing approach. But more importantly, and I said this point is very key, more importantly, marginal costing approach is a technique designed principally to aid managerial decision. Why? Because it allows management to focus on the areas of the business that are critical to achieving the organization's objectives. Okay, so those are the key points and what you need to know as far as marginal costing approach is concerned. When you have your material, so you can read about the advantages and disadvantages. All those ones are pretty straightforward. Then the points that I just mentioned to you, some of them are here. I mentioned five, but you have three in this material. So that is for that. You can add the remaining two. Now, let's go back to how do you then present income statements using marginal costing approach with this person. So, sorry about that. Yes, how do you present your income statements using the marginal costing approach? All right. Um, Let me see. All right. So let's talk about how to present income statements using the marginal costing approach. Anytime you are given a question, an examiner is asking you to prepare income statement or operating statements, and then, of course, using marginal costing approach. To do this is the format you are supposed to follow. Once you can master the format, no matter how big is the question, you are good to go. You can't get it wrong. You can't get it wrong once you can master the format, and that's your starting point. Now, we are in this format, we are going to assume that we have only one period. Okay, we will assume that we have only one period because in an ideal question, examiner will give you more than one period. The period could be monthly, it could be quarterly income statement, it could be biannual income statement, it could be yearly income statement. But in our own case, in this format, we are assuming that we have only one period. Oh, sorry. It's getting through my PC. I was wondering why. Let me see. It's locked in. Anyway. All right. So when you want to present your income statement, the first item is your sales value. Okay. How do you get your sales value? You go to the question, what is the unit sold for the period? What is selling price per unit? So units sold multiplied by selling price will give you the total sales. Then you come and post. Okay. So after your sales, the next thing you are going to do is to determine the production cost. Some of the features that I mentioned under marginal costing approach, now is the time for you to put it into practice. Now, immediately after the production cost, you need to determine the value of the opening stock. How do you determine the opening stock? So like I said earlier, let's say, for example, we have opening stock. We are given opening stock of, say, 10,000 or 5,000 units for simplicity. We are given opening stock of 5,000 units for simplicity. Now, you then go back to the question, what are the variable costs per unit? So you then go back to the question, if you can identify, if you can see direct material cost per unit. Let's say direct material cost per unit is 3 naira. We're also given direct labor to be 2 naira. We have direct expenses, okay, to be 1 naira. Then we also have variable production overhead. Let's say, for example, variable production overhead let's say is 4 naira. So when we add everything together, then we have 10 naira. This 10 naira is total variable cost per unit. That's total variable cost per unit. If I now want to determine the value of my opening stock, so I would then say opening stock equal to 5,000 units multiplied by 10 naira. Okay, 5,000 units multiplied by 10 naira. This will give us 50,000 naira. So with this, I have determined the value of my opening stock. Then I will come and post. That's all you need to do. But if you go to the question for the first period, if you are not given opening stock, just put a dash. Just put a dash. Don't need to write, just put a dash there. Okay? Now, after opening stock, the next thing you are going to do, you go back again to the question. If you are given direct material cost per unit, then in that case, you need to multiply the direct material cost per unit with the actual unit produced for the period. You multiply direct material cost with the actual unit produced, then you come and post. The same thing with direct labor. You go to the question, if you are given direct labor cost per unit, you multiply the direct labor cost per unit with the actual unit produced, then you come and post. If you are given direct expenses, you multiply direct expenses per unit with the actual unit produced, then you post. If you are given fixed production or variable production overhead, you multiply the variable production overhead with the actual unit produced, then also you post. All right, because we are told that under marginal costing approach, production costs production costs are determined by adding together all total variable costs per all total variable costs. Okay, if you want to determine production costs, just add up all the direct costs or variable costs, total variable costs or total marginal costs. Okay, you add them together to get the production cost. Okay, so when you add all of this together, you are going to have cost of goods available for sales. Okay, we have cost of goods available for sales. Immediately after the cost of goods available for sales, the next thing you need to do is to deduct closing stock. You need to deduct closing stock. In this case, examiner will never give to you closing stock. You are the one that will determine the closing stock. So there's a format I will give you later on. So you are the one that will go and work it out. Then you multiply with, once you get the closing stock in units, you now multiply with total variable cost per unit. Okay. After that, you post. So the difference between the cost of goods sold and then the closing stock, the difference between cost of goods available for sales and the closing stock will give you cost of goods sold. This will give you cost of goods sold. After you have determined the cost of goods sold, the next thing that should follow is variable non-production cost. I repeat, immediately after the cost of goods sold or cost of sales, the next thing that should follow is your variable non-production cost. There are some costs that are variable but not related to production. For example, you can have variable selling and distribution expenses. You can have variable admin expenses, all those sales commission and all of that, because they are variable but not related to production. So you need to add them. You add them together, then you add it to cost of goods sold. So the cost of goods sold plus the total variable non-production cost. So it's what you are going to deduct from the sales. You deduct them from the sales to have your contribution margin. Remember, I told you earlier on, that marginal costing approach recognizes the contribution margin, unlike absorption that uses gross profit. So this is what I was trying to say at that time. Okay. Also, I mentioned to you when I was explaining the key points that marginal costing approach is an accounting system whereby the period cost incurred are written off fully from the aggregate contribution, right? So you can see here is our contribution margin. After the contribution margin, you need to less the period cost. The period costs are those costs that are fixed in nature. Okay? So under this, we have fixed production overhead. Now, I also mentioned to you when I was explaining the concepts of marginal costing, the key point. I said that under marginal costing approach, fixed production overhead is a cost, another cost. Fixed production overhead and other fixed costs are costs that have no sympathy for activity level. That is, irrespective of the activity level, irrespective of number of units produced, they will remain constant. And I told you that the fixed production overhead is based on the budgeted output. It will remain constant because it is based on the budgeted output. So here is the fixed production overhead. Here is the fixed production overhead. So when you now want to determine this fixed production overhead, you are supposed to go ahead, go to the question, identify the budgeted output. Identify the budgeted output. Okay? Then multiply with fixed overhead absorption rate. So if examiner did not give to you fixed production overhead, certainly you are going to be given fixed overhead absorption rate. The fixed overhead absorption rate is just fixed cost per unit. Okay, so you multiply the fixed overhead absorption rate with the budgeted output or normal capacity. So that will give you your fixed production overhead, all right, under the marginal costing approach. And that is what you are going to post here. Okay, that's what you post there. Then you go back to the question. If you have any other fixed cost, okay, any other fixed cost, then you you put it under your period cost. You can have other fixed costs such as such as fixed selling and distribution expenses, fixed admin costs, all of that. Any fixed cost that you have in the question, add everything together under the period cost. Then you less from the contribution, because we have said already that under marginal costing approach, period costs are written off fully. That is, they are deducted from the aggregate contribution. This guy here is our aggregate contribution. Therefore, the entire fixed cost should be deducted from the aggregate contribution. Okay? So whatever you have thereafter will represent your profit before tax. When you deduct period cost from the contribution, it will give you profit before tax. So you then go back to the question, if you are given company tax rates, if you are given tax rates, then you are going to multiply profit before tax with the tax rate given to you. Let's say, for example, the profit before tax is 1,000 naira, and we are given tax rate of 30%. So I will just say 30%, 1,000 multiplied by 30%. That will give me 300 naira. Therefore, I will then deduct 300 naira from the 1,000. That means my profit will be 700 naira. Okay, so this is the format for presenting or preparing income statements using the marginal costing approach. Okay, so that is as per that under marginal costing approach. Let me know if you have any question on this before we move to absorption costing approach. Okay. All right. So if there are no questions, let me go ahead to discussing the absorption costing approach. Now, remember earlier today, I mentioned that there are two methods of presenting income statement. One is marginal costing approach, then two, absorption costing approach. We just finished discussing the marginal costing approach. The next one is absorption costing technique. What do you mean by absorption costing technique? The absorption costing method is a concept that charge the total cost of production, including variable costs and fixed production overhead to the unit cost of a product. I repeat, absorption costing approach is a concept that charge the total cost of production, including the total variable cost plus the fixed production overhead to the unit cost of a product. Meaning that if you want to determine the unit cost of a product, we are supposed to add up all the total cost of production, both variable and fixed production overhead. Okay, both variable costs and fixed production overhead. That's what you need to do. The absorption costing technique is a concept that relies heavily on the generally accepted accounting principles for external reporting purposes. I repeat, the absorption costing technique is a method that relies heavily on the generally accepted accounting principle, GAAP. Okay, GAAP, GAAP, generally accepted accounting principle for external reporting purposes. You don't use absorption costing technique for decision making. It is made for external reporting purposes. This one can be likened to your profit or loss account. Okay, absorption costing can be likened to your profit or loss account because it relies on the generally accepted accounting principle. Unlike marginal costing that is meant for decision making, you don't use absorption costing for decision making. Okay. Now, what are the key points you need to take into consideration as far as absorption costing is concerned? Let me give you 3 or 4 of them. Let me check the charts. Okay. How do we get the closing stock, sir? Sir, can you define absorption costing again? You have the notes. Everything is in these notes now. So I have mentioned to you that the closing stock will be, I will explain it later on. Okay, because I'm going to, once I'm done explaining absorption costing, all the concepts, then we'll move to discussing how to calculate closing stock. All right, Nair, for your question. So the second question that you ask, that can I define absorption costing? You already have this material. It's the same thing you have in this material I'm explaining. All right. So, but for the purpose of so that you won't ask question and I will not give explanation or clarity. Now, what I'm saying is that absorption costing is a technique that charges the total cost of production, including the total variable cost and fixed production overhead to the unit cost of a product. And I also said that it is a technique that relies heavily on the generally accepted accounting principle for external reporting purposes. Okay, the absorption costing is for external reporting purposes. It's not meant for management consumption. It's for external reporting purposes. Okay. All right. And I said that it can be likened to your normal profit or loss account. Okay. Normal profit or loss account. Now, what are the key features you need to take into consideration as far as the absorption costing technique is concerned? Okay, Naya, you have seen it. That's fantastic. All right. So you can just read the advantages and disadvantages of absorption costing. All right. So let's talk about the key points or the features of absorption costing method. The first point is that opening and closing stocks, okay? Opening and closing stocks are valued at total cost per unit, all right? Under absorption costing technique, opening and closing stocks are valued at total cost per unit. For example, if I want to determine total cost per unit, okay, I want to determine total cost per unit. I will go to the question, I will pick. If I'm given direct material, I will take it. Direct labor, I will add it. Direct expenses, I will add it. Variable production overhead, I will add. Let me write that. Okay, then also I will check from the question. Certainly, I will be given fixed production overhead. I will add it. So you add all of this together. So that will give you the total cost per unit. So once I have the total cost per unit, I will then go back to the question to go and multiply with the opening stock in units as given to me. All right, so that will give me the value of the opening stock under the absorption costing method. I will then post. To now get the direct material cost, of course, is the same thing. The same way you calculated direct material under marginal costing technique is the same way you are going to calculate under absorption. Just pick the direct material cost per unit. You multiply with the actual unit produced. You post. Direct labor cost per unit. You multiply with actual unit produced. You post. Direct expenses per unit. Multiply with the actual unit produced. You post. The variable production overhead per unit, you multiply with the actual production volume, okay? Then you go back to the question again. You pick. Oh, sorry, I'm explaining. I've not even reached here. Sorry, I've jumped something. I was explaining the futures. Okay, we'll come back to the format later on. So I was explaining the futures. So so that's basically that. Opening and closing stocks are valued at total cost per unit, and this is how to determine the total cost per unit. Then the second point you need to consider is that under absorption costing approach, fixed production overhead is part of production cost. I repeat, under absorption costing technique, fixed production overhead is part of production cost, and it will vary depending on the activity level. I repeat, under absorption costing approach, fixed production overhead is part of production cost, and it will change, it will vary depending on the activity level. Even though we call it fixed production overhead, look up. Oh, my pen has because I pause. That's why I like to write something on the screen so that my pen does not stop. That stop now. So I have to just let me see. Resume recording. Okay. Now, the second point I repeat, under absorption costing approach, fixed production overhead is part of production cost, and it will vary depending on the activity level, which means that the more a company produce, the more the fixed production overhead that the company will incur, and vice versa. For example, if I want to determine fixed production overhead that I'm going to consider under the production cost. Let's say, for example, in a particular period, the company produce uh, 2,000 units. In another period, the company produce, okay, let me use a simpler, let's say 1,000. In another period, the company produce 800. Then in a third period, the company produced 1,200. Let's say the fixed overhead absorption rate, the fixed cost per unit in this organization, let's say is 3 naira. Okay, let's say it's 3 naira or 5 naira per unit. Okay, let's say the fixed production overhead is 5 naira per unit. So in this case, if I now want to determine my fixed production overhead under each period, I would then say 5 naira multiplied by 1,000 for the first period, second period, and then third period. So for the first period, 5 naira multiplied by 1,000 will give us 5,000. For the second period, 5 naira multiplied by 800 naira, sorry, 800 units, okay, will give us 4,000 naira. In the third period, 1,200 multiplied by 5 naira, that will give us 6,000 naira. You can see that the fixed production overhead is changing. The more a company produces, the more the fixed production overhead that will be incurred, and vice versa. And that is why I said that fixed production overhead is part of production cost, and it will vary depending on the activity level, depending on the production volume. The more the company produce, the more the fixed production overhead that will be incurred, and vice versa. So from this, our hypothetical figures, you will see that when the activity level increases to 1,200, our fixed cost, our fixed production overhead was 6,000. When the activity level reduced, is 800, the cost reduced to 4,000. Okay, so you can see the more the company produces, you can see that fixed production overhead is changed, even though we call it fixed production overhead. Why is it changing? Why is it changing? Because it is based on the actual unit produced. It is based on the activity level. So if the activity level is constant, it will also be constant. So that is the second point under the absorption costing approach. The third point is that absorption costing approach uses contribution, unlike marginal costing that uses contribution margin. I repeat, the second feature or point to consider is that absorption costing is a concept that uses gross profits, unlike marginal costing approach that uses contribution. That's the third one. All right. And the last one, the last point is that under the absorption costing approach or absorption costing approach recognizes overhead absorption costing. Okay. Absorption costing approach recognizes overhead absorption costing. All right, so those are the 4 points that you need to consider as far as absorption costing approach is concerned. The first point is that uh, opening and closing stocks are valued at total cost per unit. The second point, fixed production overhead is part of production cost. and it will vary depending on the activity level, which means that the higher the activity level, the higher the production volume, the higher the fixed production overhead to be incurred and vice versa. And then the last point, the third point is that absorption costing approach uses gross profit, unlike marginal costing that uses contribution margin. And the last one is that our absorption costing approach recognizes overhead absorption costing. Those are the four key points you need to take into consideration as far as absorption costing approach is concerned. So you may want to read more on this. You may want to read more on this. These are some of the points. I mentioned four, but you have three here. So all right, so that is as per that. The next one is to now discuss the formats. Okay, you need to master the format for presenting income statement using the absorption costing approach. All right. So when you want to prepare the operating statement using absorption costing approach, the first item is the sales value. The same way you calculated the sales value under the marginal is the same way you are going to do under absorption. Just multiply the units sold with the selling price. So it will give you the total sales. Now, to determine the production cost, remember, we said that under absorption costing approach, we said absorption costing is a concept that charge total cost of production, uh, including total variable costs and fixed production overhead to the unit cost of a product. So the first item will be your opening stock. You go to the question, where is the opening stock in units given to me? If any, multiply the opening stock in units with the total cost per unit. The total cost per unit you have determined here. Okay, the total cost per unit you have determined here. So you multiply with the opening stock in unit as given to you. Then you post. You go back to the question. If you are given any direct material cost per unit, multiply the direct material cost by the actual unit produced, you post. Multiply direct labor cost per unit with actual unit produced, you post. Multiply direct expenses per unit with the actual unit produced, you post. Multiply the variable production overhead per unit with the actual production volume, you post. Again, multiply the fixed cost per unit, or you call it fixed production overhead or fixed overhead absorption rates. So you multiply with the actual unit produced, all right, to get your fixed production overhead. Then you post. You then add up everything together to get your cost of goods available for sales. So immediately after the cost of goods available for sales, you need to go and determine your closing stock. You work it out first. You need to work out the closing stock in units. Then after that, you multiply with the total cost per unit to get the value. Then you come and post. The difference between the cost of goods available for sales and then the closing stock will give you the cost of sales or cost of goods sold. Now, pay attention here. Immediately after the cost of goods sold, you must adjust for overhead absorption. You have to adjust for overhead absorption. I will explain to you later on what is overhead absorption, what do you mean by under or over absorption, how do you treat it in a question. I will explain it later on, all right? But for now, you are going to adjust for overhead absorption immediately after the cost of goods sold. Then whatever you have, okay, whatever you have, you less it from the sales value. So that will give you gross profit. Okay, I mentioned to you the other time that absorption costing uses gross profit. This is what I mean by that. This gross profit you have here is what I mean by that. Now, immediately after the gross profits, you need to consider non-production cost. You must consider non-production cost, whether it is variable or fixed. Any non-production cost, you need to adjust under the non-production cost. Okay, you just add all of them together. If you have variable selling and distribution, fixed selling and distribution, variable admin cost, fixed admin cost, any other cost that you have that is not related to production, add all of them together, then you less from the gross profit. Whatever you have thereafter will represent your profit before tax. Okay, that will represent profit before tax. Now, immediately after the profit before tax, you have to charge income tax. So the income tax is the profit before tax multiplied by the company tax rate. Okay? Income tax is profit before tax multiplied by income tax rates. Then you deduct whatever you have thereafter will represent your either net profit or loss. Okay? It will be either net profit or loss. So this is how to present income statements using the absorption costing approach. Please, your starting point, okay? Your starting point for you to be able to understand the operating statements, your starting point is to master the formats. Even though it's been a while that ICAN tested marginal and absorption costing or operating statements in performance management. It's been a while, but you never can tell. You don't know what examiner have in stores for you. And that's why you don't leave any topic behind when you are preparing for ICANN exam because you are not the examiner. You don't know where examiner will come out to you. Where you least expected, maybe the place that maybe the topic that ICANN examiner will just go there and test it. And that's why you must ensure, no matter how little, on the average, ensure that you have understanding of what each topic is all about. If you can do 100%, fantastic. But if not, just ensure that you have knowledge of what each topic is talking about so that if an examiner is asking you something, you'll be able to write down something. All right, that's the way to go. Okay, this point, the next area we are going to discuss is how to determine closing stock, how to calculate closing stock. Before we go there, let me know if you have any question for me. I'll give you 1 minute. If you have any question for me, let me know. All right. Okay. All right then. Yes, Mary, talk to me.
Okay. Good evening, sir. So, sir,
Good
I want to
evening.
ask in the format, please, sir, can you go back to
Yep.
the format, sir? So,
Okay.
where we have that stock valuation, those places you were mentioning, multiply the marginal cost by this, multiply this by that. Are they going to give us in each questions?
Give you what? Give what?
For example, this direct material now, you were saying that we are going to
Yeah.
multiply variable
Yes.
something by the and
Yeah.
everything. Are they going to
It
give
will
us
be
in the
given to
question?
you. Yes,
Oh, okay.
examiner will give to the cost per unit. You are going to be given the cost per unit in the question. It will be given to you.
All right, sir.
The unit produced also will be given to you. So just multiply the cost per unit with the units produced to get the production cost. Yeah,
Okay, sir. Thank you, sir.
you are welcome. Now, let me show you how to calculate closing stocks. Okay, how to calculate closing stock. And after that, we are going to discuss variance analysis. Okay, we are going to discuss variance analysis between marginal and absorption costing. Then finally, we are going to discuss overhead absorption um, costing, okay? Overhead absorption costing. So we have three more areas to discuss before we begin calculations. Now, because of space, let me use working notes to explain how to calculate closing stocks. You can open to this material at your end, okay? You can open to this material at your end in case I want to make a reference. However, I want to switch to the working note so that I can properly explain to you how to estimate closing stocks. Okay, all right. determining closing stock. Okay. So we are assuming that we have only one period. If you have more than one period, you are going to do, let's say, for example, you have two periods. So you are going to create columns on your right for, for each period. Okay. If you have three periods, so it's a column. You create about three columns for for the three periods. But in our own case, we are assuming that we have only one period for this format. So we want to determine uh, closing stock in units. Okay. So to determine closing stock in units, the first thing you are going to do, you go to the question. If you are given opening stock, you pick it. Opening stock, whatever you are given, come and put it there. Let's say, for example, in 2025, December 31st, 2025, there are some goods that were not sold. There are some goods that were not sold. So as you move into 1st of January 2026, the closing stock of 31st December 2025 will become opening stock. So you come and put it here. So in 2026, any unit produced, actual unit produced, you add it to the closing stock. So add actual units produced. Whatever it is, add it up. This should give you the total units available. Total units or stocks available for sales. All right, your opening stocks plus actual production volume or actual output will give you the total units available for sales. These are the units the company will sell in the market. Now, it is possible that at the end of the year, you are going to identify, you determine your total sales. So you less your sales, less units sold. When you less units sold, the difference will give you the unsold stock, which we call closing stock. Closing or unsold stocks. All right. This is, of course, is in units. Okay. So this is how to calculate the closing stocks in units. To now determine the value of the closing stock, I will then come here, valuation. I want to value the closing stock now. Okay, valuation. I will then go to the question. Say, for example, we want to prepare closing stock in value for marginal costing approach, then for absorption costing approach. So under the marginal costing approach, I will pick the units, this unsold stock in units. That will be the units multiplied by, remember, under the marginal costing approach, we said that opening and closing stocks are valued at total variable cost per unit. So I will then go and calculate the total variable cost per unit. So I will come here, total variable cost per unit. So whatever I have will then be my the value of my opening stock under the value of my closing stock under the marginal costing approach. I will do the same thing for ACA. Under the absorption costing approach, the unit unsold, this closing stock in unit multiplied by the total cost per unit. Okay, so that will give me the uh total value of the closing stock under the absorption costing approach. So this is how to estimate closing stock, the value of closing stock under the marginal costing approach and then absorption costing approach. Like I told you earlier on, examiner will not give to you closing stock. You are the one that will determine it. How to determine closing stock under marginal and absorption costing approach is what I've demonstrated for you. To do this, first thing first, you need to calculate the closing stock in units by following this format. All right, follow this format. Then to now get the value, just multiply for MCA, marginal costing approach, multiply the closing stock with the total variable cost per unit. Under ACA, absorption costing approach, multiply the closing stock in unit with the total cost per unit. So I believe that is clear. All right, let me see. Somebody is sending me a message. What are you saying? Let me please. That is coming from Babajide Ajayi. You are saying, please, with the change to the reporting format in income statement under IFRS also affects the way the operating statements. No, 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 no. It's not. You know, the new IFRS 18, that one is like I mentioned to you, your income, your profit statement of profits or loss accounts is for public consumption. This one is for management consumption. So you are not publishing it. All right. It's not something that is going out for external users. So it's not, we are less concerned with what is happening with IFRS 18. All right, Jide. So yeah. It will not affect the format of this one. That one is only in a financial account or financial reporting. Okay. All right then. Yes. So now that you know how to estimate closing stock, the next thing we want to do is to now determine variance analysis. After variance analysis, then we talk about overhead absorption costing. Now, when you talk about variance analysis, the income statement produced using marginal costing approach and absorption costing approach will not produce the same results. I repeat, when you talk about, let me put it down, variance analysis. Okay, variance analysis. The income statement prepared using marginal costing approach and absorption costing approach will not produce the same results. When you talk about results, we are saying the net profit. So the net profit under marginal costing approach will certainly be different with the net profit under the absorption costing approach. Okay, except by accidents, it can never be the same. Why are they not the same? The reason why they are not the same is because of the method of valuing stocks. Okay, I will repeat again because examiner can ask you this as a sub-requirement in a question. Why is the income statement under or net profits, okay, or operating performance under marginal costing approach and absorption costing approach are not the same? So this is the analysis, this is the explanation you are going to give. So what I'm saying is that when you present your income statement, all those two formats that I've explained earlier today, all right, when you look at the bottom line, you are going to see net profit or loss. So what we are saying is that if you prepare income statements using marginal costing approach and absorption costing approach, the answer, the net profit or loss can never be the same except by accident. Why are they not the same? That is what I want to explain to you. Okay, so the income statement prepared using marginal and absorption costing approach will produce conflicting results because different methods are used to value stock. The key reason why they are not the same is because different methods are used to value stocks. Under the marginal costing approach, stocks are opening and closing stocks are valued at total variable cost per unit, whereas under the absorption costing approach, opening and closing stocks are valued at total cost per unit. So this is what is causing the variance. Therefore, the delta, the difference or the variance between the operating performance of the two techniques, all right, can be reconciled using the reconciliation statement. Okay, so you can use reconciliation statement to agree the difference between the net profit of the two techniques. So anytime in a question under operating statement and you are asked to prepare reconciliation statement, this is what you are supposed to do. So you then come here. I've already explained to you the variance analysis and what is causing the variance. It's also in your notes, the note I shared with you the other time. So you can always go back there. So then to prepare your reconciliation, okay, to prepare the reconciliation statement, this is the content. This is what you should do. In fact, I like this topic because of the fact that is a kind of a self-appraisal topic, such that if in a question you are given operating statements and you prepare your reconciliation statement, the difference in profits before tax equal to this difference in stock valuation, it means that what you have done is perfectly okay. You can be rest assured that you have 15 marks or 20 marks to pocket. Okay, so you go ahead and look for 85 or 80 marks to go. Okay, now I'm going to create two naira sign anytime you want to present your reconciliation statement, depending on how many period you are given. All right. In our own format, we are going to assume that we have only one period. Therefore, you create two naira signs, credit and debit. Okay. Now, you then go and find the difference. Okay. You find difference in profit before tax. Please, it is not difference in net profits. It has to be profit before tax. In your in your income statement that you have prepared, you go and identify, you go and pick the profit before tax that you have calculated. So you pick under ACA, under absorption costing approach, whatever you have calculated as your profit before tax, come and post it there. Go to MCA, marginal costing approach. Go and pick the profit before tax, you less. The difference between these two will give you, this represent the difference in profit. This is the difference in profits. Let's say this is A. So you can see the difference in profit that you have computed. Then you also determine difference in stock valuation. Okay, so you come here, difference in stock valuation. All right. To do this, there are two different types of stocks. We have opening and closing stocks. So you are starting with the closing stocks. So you come here, closing stocks. Let me manage this space so that I don't need to move to the next page. All right. So we have closing stock. Under the closing stock, you pick ACA, then MCA. So for the ACA, you go to your calculation that you have done. Go and pick the closing stock under ACA, then you less closing stock under MCA. So you have this difference in closing stock. Then you now pick opening stock. Do the same thing under ACA, then MCA. So you then come here under the ACA. What is the opening stock? Put it here. Under the MCA, you less. The difference In opening stock, it lets it from the difference in closing stocks. So that will give you a difference in profits. So this will give you a difference in profits, which is B. Okay, so this guy must be equal to this guy. The two of them must be equal. Once A is equal to B, that means what you have done is correct. A and B must be equal. A must be equal to B. Okay, so once A is equal to B, you can be rest assured that what you have done is perfectly okay. What you have done is perfectly okay. So this is how to prepare your reconciliation statement. All right, that's how to prepare the reconciliation statement. And that is as per that. We have one more line item, one more concept to go before we begin calculations. All right. So at this stage, let me know if you have any question for me before we go to um, overhead absorption costing. Okay. All right. So in the absence of no question, let's move into overhead absorption costing. This is not in your notes. Let me put it down for you. All right. Overhead absorption costing. Okay. What do you mean by overhead absorption costing? Because of time, let me just write it down for you. This involves the process of allocating indirect costs such as rents, office rents, factory manager salary, factory manager salaries, rates, electricity, utilities, depreciation, depreciation of factory assets, machinery or plants, etc. to a product or service. So that is what is known as overhead absorption costing. So what we are trying to say is that when you want to how to charge overhead cost, how to allocate overhead cost to a product or service, that is what is known as overhead absorption costing. You want the product to, who is it? That is say you are writing on my screen, stop it. So you want the product to absorb the overhead cost. That is, you want to allocate the indirect cost, the overhead cost to a product or service. So the process of doing that is what is known as overhead absorption costing. Okay? Now, ordinarily, when the actual overhead incurred is the same thing as the overhead absorbed to a product or service, there will be no issue. It means that the overhead is appropriately absorbed. In fact, let me just put it down because of time. When the actual overhead is when the actual overhead incurred is the same as the budgeted overhead, or is the same as the overhead absorbed. Or is the same thing as, let me use budgeted as the budgeted overhead. It means that, it means that the overhead is correctly or appropriately absorbed. I will explain everything as we move on. All right. Okay. However, however, when the actual overhead and planned or budgeted overhead are different, this will result in under or over absorption, which should be adjusted from the cost of goods sold. Okay, so that is basically what overhead absorption costing is all about. Now, before we begin to discuss the concept of under or over absorptions, let me go deeper to explain certain things to you so that you understand the reason why we are doing it the way we are doing it. All right. Now, when you talk about overheads, let's say, for example, in a particular period, when the company is preparing its budget, you have a budget is just an estimate, it's not actual, right? You have estimated that, let me just put example for clarity. So you have estimated that you are going to incur rent. When you are preparing your budget, you estimate that you are going to incur rent, let's say 1 million naira for simplicity. You are going to pay electricity for the year, say 500,000. You are going to pay factory manager salary, all right? Uh, factory manager salary for the year, say 200,000 for simplicity, all right? Let's say you want to incur uh, other admin expenses, okay? You want to incur other admin expenses, or you want to incur depreciation of the factory assets, all right? Whatever the case may be, let me just put depreciation of 300,000 naira. So when you add everything together, we have budgeted for 2 million naira as our overhead cost. Let's say, for example, we are also budgeted unit we are going to produce, budgeted or budget output. Let's say, for example, we have budgeted that we are going to produce 100,000 units. Okay. So this is the basis upon which we are going to benchmark our the actual unit produced for the period. Okay, for the period under consideration. Now, if I want to determine my fixed overhead absorption rate, so I would then say the fixed overhead absorption rate is equal to the fixed production overhead, total fixed production overhead over the budgeted output. So in this case, my fixed overhead absorption rate would then be equal to what is my fixed production, all my fixed production costs. These are my total fixed costs. All right. So I have 2 million naira. Okay. These ones are in naira. So I have 2 million naira, then over budgeted output of 100,000 units. So here will be 2 million divided by 100,000 units. So my fixed production, my fixed overhead absorption rate will then be equal to 10 naira. Okay, this should be 10 naira. Is it 10 or 20 naira rather? So this will be 20 naira per unit. Okay, so I'm trying to explain what overhead of 2 million naira. The overhead that will be absorbed to each product or service to the overhead that will be absorbed to the product may be different from what we have budgeted to incur. So if what we budgeted to incur is different from what is absorbed, what is charged to the product, that will result to under or over absorption. That will result to under or over absorption. So that is my explanation here. That's my explanation here. When the actual overhead and budgeted overhead are different, this will result in under or over absorption. This under or over absorption should be adjusted from the cost of goods sold. If you remember in my explanation under the absorption costing technique, the format, I mentioned to you that immediately after the cost of goods sold, you must adjust for under or over absorption. Now, let me explain what is under absorption, what is over absorption, what do you do with under absorption, what do you do with over absorption. So that's the next thing we want to do. These figures that we have here, we can use it as well when we get there. Now let's talk about over absorption. Sorry, let's start with under absorption costing. This concept, this overhead absorption costing is very controversial, but you must you have to understand the concept, the principle behind it, so that it's not difficult. Now, what do you mean by under absorption? So like I've explained to you earlier on, in this our hypothetical figures, all these figures that you have here, they are our budget estimates. These are budget estimates. These are budget estimates. So this budget estimates, we have used this to determine our fixed overhead absorption rate of 20 naira. So this fixed overhead absorption rate, we can call it actual overhead. We can call it actual overhead per unit. This fixed overhead absorption, we can call it actual overhead. Now, if I want to determine, again, if I want to determine my actual overhead now, I will just say 20 naira multiplied by the budgeted output of 100,000, which will give me 2 million naira. So when I now want to determine my under or over absorption, I need to compare my budgeted or my actual overhead versus what is absorbed, that is what is charged to the product. When I prepared those formats for you earlier today, the fixed overhead you have under the absorption costing, the fixed overhead you have there is the overhead absorbed. What is your fixed overhead absorption rate multiplied by your budgeted output will give you the actual overhead. So you need to compare what is absorbed to a product versus what you budgeted, what is the estimate or the actual overhead. That is what is causing this difference. So let me now explain in details. What do you mean by under absorption costing? So you can say this arises when the actual overhead, is um, is lower than the overhead absorbed, When you say overhead absorbed, what we simply means is that is the overhead cost that is charged to a product. The overhead that you allocate to a product, that's the overhead absorbed. All right. So when the actual overhead incurred, okay, when the actual overhead incurred, sorry, this one is higher. Let me change it. When the actual overhead incurred is higher than the overhead absorbed to a product, okay? I said this arises when the actual overhead is higher than the overhead absorbed to a product, okay? So, this means when this happens, okay, let me put it this way. This means the cost of goods sold, is understated and profits is overstated. So when the actual overhead incurred is higher than the overhead absorbed to a product, it means that the cost of goods sold is understated while profit is overstated. So what do you then do? In this situation, the most important thing to do, let me put it down, under this circumstance, the most important thing to do is to add the difference to cost of goods sold to reflect the actual to add the cost of goods sold, is to add the difference to cost of goods sold to reflect the actual results. Okay, so that's what you need to do. Let me explain this with numbers. Let's say, for example, based on our budget above, our actual overhead, that estimate you have before you begin production, the estimate you have made, which give you this fixed overhead absorption rate of 20 naira, that is your actual. So you need to compare this actual with the overhead absorbed. The overhead absorbed is the overhead you charge to the product using your format, using your absorption costing format. So whatever you charge as your overhead using your absorption costing format, that is your overhead absorbed. So if this actual, that is what you budgeted to incur, is higher than what you actually absorb to a product, okay, that means the overhead is under absorbed. All right, that means the overhead is under absorbed. So in this case, what are you supposed to do? The difference supposed to be added to the cost of goods sold, and that difference is called under absorption. That difference is called under absorption. So the under absorption should be added to the cost of goods sold to reflect the actual overhead because it is what it is. All right. So I want to use figures to explain this further. So let's say we have budgeted, we have our estimates, our actual overhead. Don't forget what I said. The actual overhead incurred is the overhead you have planned to incur. Before we begin production, you need to make your estimates. You need to, like, all those 2 million that are listed here. These are the actual, because this is what you plan to achieve. You may think, oh, this is budgeted now, it's not actual. In actual sense, in real sense, under this concept, there's nothing like actual cost. We don't have actual cost. They are all estimates. They are all listed. You just want to determine what is the percent, what is the proper, what is the overhead that you are going to charge to a product. It's not the actual cost you are going to incur. That's not the actual, it's just an estimate. The estimated cost that you have determined versus what the project absorb, what you charge to a product. So that's the difference you want to make. That is what is causing the overhead absorption. So there's no actual cost incurred in this one. So you just literally you just budgeted stuff versus what is absorbed. So you don't come here. Say, for example, we have actual overhead of 2 million naira as we have given above. Okay. Now, your fixed production overhead, your fixed production overhead let's say, for example, you now determine the actual unit produced. Let's do it this way. You are given actual unit produced because this concept is, like I said, is very controversial. So I have to go deeper. So that you'll be able to understand the basics. So let's say the actual unit produced. The actual unit produced is 150,000. What is the units produced here? This is 100,000, okay? All right, so let's say the actual unit produced is, let me reduce this, is 80,000. Okay, that's 80,000. So in this case now, if I want to determine my actual overhead, we've determined the actual overhead is 2 million, right? So if I want to determine the overhead absorbed, so I would then say overhead absorbed. What is the overhead we charge to a product? The overhead we are going to charge to a product, our fixed overhead that we are going to charge to a product, will be the actual unit produced This is actual units multiplied by the fixed overhead absorption rate. The actual unit we have produced multiplied by the fixed overhead absorption rate. In this case, this would be 80,000 units multiplied by our fixed production, our fixed overhead assumption rate is 20 naira. This is the 20 naira we've determined here. This 20 naira, that's our fixed overhead absorption rate. So I will then multiply with, so what do we have here? This should give us 1,600,000 naira. So this 1,600,000 naira is the overhead absorbed. This is the overhead we charge to a product. The 2 million naira we have here is the actual overhead. You can, if you like, you can call it budgeted overhead or planned overhead, but that is the actual overhead. So what you actually charge to a product is the overhead absorbed. So when when the actual overhead incurred is higher than the overhead absorbed, that is called under absorption. That is called under absorption because this 1,000, this 1,600,000 has understated our cost of goods sold. It has understated our cost of goods sold and overstated our profit because if your cost of goods sold is lower, your profit will go up. So because this 1,000, the overhead we charge to a product is understated, that has made our cost of goods sold, our cost of goods sold is understated, so that has made our profit to go up, to increase. So to now correct this, the difference between the actual overhead, the difference between the actual overhead and then the overhead absorbed under the absorption, under the under absorption must be added to the cost of goods sold, must be added to cost of goods sold. So in this case now, this will be equal to the actual overhead is 2 million naira with my explanation using our hypothetical figures. This 2 million naira minus 1,600,000, that's 400,000 naira. So this 400,000 naira should be added to cost of goods sold. So that's the treatment of under absorption. So when you go back to my explanation, I said that this arises, under absorption arises when the actual overhead is higher than the overhead absorbed to a product. Your actual overhead literally, or we can say literally, is the what you budgeted to incur. All right. So to do that, to get your actual overhead, it will be what you budgeted to produce versus, multiply by the actual, multiply by the fixed overhead absorption rate. That will give you your actual overhead incurred. Now, you need to compare this with the overhead absorbed. The overhead absorbed is what you actually charge to a product using your format, using what you have in your format. So if what uh, you actually intended to incur is higher than what you charge to a product, that means the overhead is under is over the overhead is under absorbed. So if the overhead is under absorbed, the difference you add it to the to your cost of goods sold in order to reflect the actual overhead. So that is the explanation of under absorption. Then let's move to the second one, which is over absorption. Over absorption. Okay. This occurs when the actual overhead is lower than the overhead absorbed to a product. Don't forget what I said earlier. The overhead absorbed is the overhead charged to a product, allocated to a product, so that you don't mix it. So this occurs when the actual overhead is lower than, okay, is lower than the overhead absorbed to a product. This means that the cost of goods sold, or this we make, let me put it this way, this we make cost of goods sold to be overstated. And profits to be understated. So when this happens, the difference should be adjusted. The difference should be deducted from cost of goods sold to reflect actual overhead incurred. Okay, so that's the treatment of, let me underline this. That's the key point there. So this is the treatment of over absorption. Let me go back. How to is to add the difference to cost of goods sold. Let me just difference to cost of goods sold. Then this one higher than. So those are the key points you need to consider. Now, let's use an example just to explain this. This is the last area we are going to explain. Now, let's say, for example, we now produce, in our example here, the actual overhead is 2 million, right? The actual units produced, the actual production volume is 80,000 units. Meanwhile, of course, the actual, the budgeted output, let me add it, budgeted output, which we used before, is 100,000 units. Okay, 100,000 units. All right. So let's come under the over-absorption now. Our actual overhead still remain as 2 million. Our actual overhead remains as 2 million naira with budgeted output of 100,000 units. Then the actual production or actual unit produced for the period, let's say, is 120,000 units. And you know that our fixed overhead absorption rate still remain as 20 naira per unit. because 2 million divided by 100,000 units will give you 20 naira per unit. So this is the information you have. So in this case now, if I want to determine my overabsorption, we said that overabsorption will arise, okay? The overabsorption will arise when the actual overhead incurred is less than the overhead absorbed. So in this case, I will then say the actual overhead, let me put it this way, overhead absorbed will then be equal to the overhead absorbed is the actual unit produced, which is 120,000 units multiplied by the fixed overhead absorption rate of 20 naira. So when you multiply, that means we are going to have 2.4, 2,400,000. Let me write that. 2,400,000. So that's the overhead absorbed. To now get my over, I would then say the variance now in this case, variance would then be equal to the actual overhead, minus overhead absorbed. Remember what I told you. Overhead absorbed is the overhead charge or allocated to a product. This is the overhead. The overhead absorbed is that overhead you indicated or you post in your format. The overhead you post in your format, that is the overhead absorbed under the production cost. That is your overhead absorbed. So the variance now will then be equal to the actual overhead incurred is 2 million naira versus the overhead absorbed of 2.4 million. 2,400,000. The difference of 400,000 naira is called overabsorption because the actual overhead is less than the overhead absorbed or the overhead charged to a product. So that difference of 400,000 naira is overabsorption. This is what is called overabsorption. So this is overabsorption. Must be deducted from the cost of goods sold. This must be deducted from cost of goods sold. So when you go back to my explanation here, you will see that I said this occurs when the actual overhead is lower than the overhead absorbed to a product. The overhead absorbed to a product is the actual unit produced multiplied by the fixed overhead absorption rate. That is the overhead you have allocated to a product. You need to compare that with actual overhead. Your actual overhead is the budgeted output multiplied by the fixed overhead absorption rate. So the difference between the two, we give it the absorption we are looking for. So this is the explanation about under and then over absorption. So for simplicity, let me give you a kind of a code or let me a formula. Let me give you a formula. All right. So it will be under absorption. Let me put it this way. Under absorption equal to actual overhead minus overhead. No, not minus. First thing for actual overhead less than overhead absorbed. Let me write that. Let me go to the next page. Okay. note under equal to actual overhead, or you say budgeted overhead. Actual overhead greater than overhead absorbed. Overhead absorbed. Let me write it because of space. Actual overhead is greater than, when actual overhead is greater than overhead absorbed. So the difference is called under absorption. So if it is under absorption, this should be add to cost of goods sold. That's what you need to do. The second one, it will be over absorption if actual overhead is less than overhead absorbed to a product. Overhead absorbed to a product. So when this happens, the difference between the actual overhead and overhead absorbed should be deducted from cost of goods sold. So this is what you need to take into consideration. So that's the point you need to know as far as the overhead absorption costing is concerned. And then this will be the end of the explanation of the concept. Let me know if you have any question for me. At this stage, we cannot do any calculation today because with the time we have, we won't be able to complete it. So in our next class, we are going to solve questions purely, and then we are going to end this topic in our next class, in our next meeting by the grace of God. All right, so I've taken my time to explain all the necessary concepts under absorptions, so under the operating statement. So in our next class, we'll just be solving questions. So before we close the class, let me know if you have any question for me. Let me even show you, let me see, let me open to Golden Book. Let me open to Performance Management Golden Book. I think I explained this in details there as well. Let me see. 1 minute, please. Let me just open. Do I have it? Let me just, where this is that? Okay. Let me see. Please ensure you go through your whatever you have learned so far since we started. As we are about to, we are starting this. Today is the last day for the week since we started. Tomorrow, Saturday, we are starting a new one. All right. So that means we have completed 7 weeks, 7 days lectures. So tomorrow will be the 8th day that we have started this diet. So please, I want to encourage you guys to develop uh, your studying calendar. You need to create a study calendar. You can't be reading randomly. It's very important. You can't be reading randomly because when you do that, when you read randomly without a structured plan, you can't achieve much. Monday to Sunday, you should have a minimum of 2 hours per day that you are going to read out of 24 hours. Irrespective, you have to determine when it is convenient for you to read, whether in the afternoon, in the morning, or in the night. You just have to create time to read. And whatever you have scheduled to read in your timetable, you have to be committed to it. Because it's one thing for you to say you want to read, and it's another, it's one thing for you to have scheduled a very lovely reading calendar. And then it's another thing for you to be able to be committed to it religiously. All right. So please, this is very important. Across all the subjects that you are going to register for, Mondays to Sunday, you have to schedule for it. Let's say, for example, at skills level, you are writing 6 papers. You are writing all the papers, and you have 7 weeks in a 7 days in a week. So that means you are going to have, let's say, for example, you can pick maybe performance management and the financial management. Okay, I will read all of them per one subject per day. I will read one subject per day. Then the one day that I have extra, you can read maybe performance management for 1 hour, financial management for the second hour. So that means you are reading you are reading performance management for 1.5 hours in a week. All right. Please, this is very important. And you have 17 weeks, or let's say 19 weeks or 20 weeks preparatory to your exam. Okay, please. This is very important for you to achieve excellence. Don't wait till the last moment before you begin to read. It will affect you. Early preparation is key for you to pass your ICAN exam. Now, this is my golden book on performance management. So I just want to show you I just want to know whether there are other things I need to call your attention on. Okay. Of course, this is when you say golden book is not ordinary book. It's something that is unique and special. You know, what the content you have in this golden book, you can't see it elsewhere because I took my time for years to develop this. And it's something I developed it with students pain points in mind. I could remember when I was developing this topic by topic, I do share with my students and they bring in their feedback and I incorporate those feedbacks in the final product, and that's what makes the book to be very unique because from the beginning I have to incorporate the interest of the student. Now, I just want to check if there are other things I've not talked about. So, like I said, you have to read the advantages and disadvantages. I think you have more advantages in the Golden Book. Then the features as well. This one I listed 7. In any case, I've explained that. So you can see them through. The format is the same thing. This is the same thing. So just ensure you read them. Now, the over absorption, all what I've explained to you today in the over absorption costing, they are also here. All right. So you can read them through. Sorry, if you have the golden book, so you can read them through. All right. So I think, oh, okay, I did not show you this. I just explained it. I did not give you the format. Don't worry. When we are doing our calculation in our next class, we are going to this. I did this only that I did not put it in a table. Yeah. Okay. And I also did this one. So I think that's that. I also showed you how to calculate the fixed overhead assumption rate. The only thing I did not mention to you is the reasons for overhead adjustments. Why do you have to adjust the overhead from the cost of goods sold? All right, these are the reasons. The number one reason is to ensure fair and accurate profit reporting. I told you the other time that under absorption, the difference should be the under absorption simply means that the cost of goods sold is understated. And if the cost of goods sold is understated, the difference should be added to the cost of goods sold. Okay, if it is under absorption, so the difference should be added to the cost of goods sold because the cost of goods sold already is understated. So you need to add the difference to it in order to reflect, in order to ensure that the profit is accurately reported, because if it is under absorption, then the profit will be overstated. So, and that's why you have to add it to the cost of goods sold to ensure that it reflects the actual result, that is the actual profit. Then the second reason for adjustment is to ensure production cost is accurately reflected. That is the cost of goods sold. You want to ensure that your cost of goods sold is accurately reflected. Then number 3 is to avoid misleading stock valuation. Then 4, to ensure cost of goods sold reflect the actual overhead incurred. And then the last one is to enhance the reliability of the financial statement. So these are some of the reasons for overhead costing adjustments. This is one of the some of the reasons you adjust for your overhead costing. Okay, all right. Now, of course, again, this also is the reasons or causes for under or over absorption. So if you have the golden book, so for those of you that have it, you can go through it and add more. So I've explained the how to value our closing stock under each method. I've explained that already. All right. So I've also explained the variance analysis. I think I've covered everything. Yeah, I've covered everything. So we are good to go. In our next class, by the grace of God, we are going to be solving questions. So we are going to be solving questions. And then if you need the golden book, okay, if you need the golden book, the hard copy, the printed copy is 17,000 naira per copy. The ebook, the ebook is 8,000 naira, and the access will expire 30th of June. So if you need the ebook, the earlier you get access to it, the better for you, so that you can use it for as long as you want, up to end of June 2026. All right, because the ebook, the access is for every diet. All right, but if you want the hard copy, it's 17,000 naira, excluding delivery costs. If you are maybe you are outside Lagos and you want the printed copy, we can deliver to you in your any destination. I mean, in any location you have. So at your own cost. All right. So that will be the end of today's class. By the grace of God, next week, Friday, again, we are going to meet when we are going to be solving questions. My suggestion will be that if I were you, I will go ahead and try all the examples that you have in the question. That's the way to go. Go and try all the examples you have in your class material. I think you have about 3 different questions there. So go and try them all. Go and try them, so that by the time we are doing the solution, if you make any mistake, you'll be able to correct yourself. Already you have idea. Okay, you have idea. I've given you the format. Just go ahead and solve it. And then in our next class, when we solve it in the class, we can then compare with what you have done. That's the way to learn. All right. So uh by the time when we meet next week, by the grace of God, I'm going to be telling you 1 or 2 things that you need to be doing on your own, so that you can have a beneficial outcome when your result is released. Because time and time wait for nobody. Before you wink, it will be end of April, and you'll be looking at few days. Okay, you'll be looking at few days to your exam in May. Please, early preparation is key for you to succeed in ICAN. Yearly preparation is very essential. Don't joke. You are spending money for your lectures. You are spending money for exemption. You are going to spend money for exams. You are consider the sacrifice you are taking. You can imagine this is almost 11 p.m. All right, you are supposed to be sleeping by now after a hard day work in the office. But here you are attending lecture. So you should make your effort count. The efforts we only count if you succeed in that exam. And that's what I'm encouraging you. Please take it very seriously. ICAN exam is not difficult. It's not difficult. It's your own approach. It's your approach that is making it difficult. Please take it very seriously. Start reading now. You have started lecture. Start reading now. Don't wait till the last moment. If crashing does not work, if you follow crash, maybe a month to the exam, and after that you want to understand everything, it doesn't work that way. It doesn't, because as you read something, the thing will enter from the left here to come out from the other side, because you don't have the in-depth, knowledge, and that's why you have to. It takes time for your memory to process all these things that you are reading, all these things that you are learning. It takes time for you to understand it, and that's why you just have to keep on practicing, practicing, practicing. You can see your lecturers, also all of us were just dishing out lecturing to you without looking anywhere, because we do it over time. It's something we do, something you practice. Once you practice, the thing will become part of you. And that's what you should imbibe. That's the approach you should adopt. Please, there's no day you should not read because your money is already counting. Your money is counting. You are going to a war. You are going to a war with ICAN come the third week in the month of May. You need to develop your strategy. You need to design strategy for you to be able to defeat ICAN on that day. And that is one of the things I'm telling you now. Yearly preparation is key to your success. You need for you to have that yearly preparation, you have to schedule your reading timetable, Monday to Sunday, the papers you are going to be reading per day. Please, this is very important. God will make it easy for you. So this will be the end of today's class. So in our next class, by the grace of God, we are just going to be doing calculation. On a last note, let me know if you have any question for me so that we can close the class. Any question for me? Do you have any question for me? I can see Kayode Alabile is still on. Anif is on. Babajide Ajayi is still on. Chidera, Igwe, Gloria, Fabino, Idrisu Yakubo, Ijoma, Obiejese, you are still on. Then we have Joshua Indubisi is still on. Mary Oluwatosin, Gift, Ochanya, Oluchi, Victoria, Oluwatosin Akinseye, Oluwatoyin Abosede, is Opo, OPPOCPH2, whatever. Anyway, then Oreoluwa, Oren, how are you? Ore, okay.
I'm
So
fine, sir. Good
Rosemary,
evening.
how are you doing? Yeah.
Very well, sir.
Yeah. Rosemary, Dominic, Samuel James, Temitope Daramola, Ugo, Neye, my friend. Neye said I'm too fast. It's my nature, Lord. Hey, I will be adjusting little by little. All right. I have Zemi, my Marco. Is it my Marco or my Marco? Sorry for mispronouncing your name. All right. Okay, and the rest. Thank you everyone for joining the class. I will see you next week by the grace of God. Good night. Bye-bye.
Good night, sir. Thank you so much, sir.
Good night, sir.
You're welcome.
Good night, sir.
Thank you, sir.
All right, good night.
Thank you, sir.
You're welcome.
I will be glad to have the election note tonight.